We are now going to start our first panel. The first panel is entitled Legislative Landscape in Light of Potential Tax Reform. The panel is co-presented by IFA USA and Tax Notes. The chair is Ben Willis from Tax Notes, somebody that everyone in this audience knows. Let me tell you a little bit about Ben. Ben is a contributing editor for Tax Notes and an adjunct professor for Villanova's graduate tax program and law school. He served in various governmental roles from 2013 through 2017. These included rotations at the U.S. Treasury, the Office of Chief Counsel, and the Senate Finance Committee staff. Ben, take it away.
Great. Thank you so much, Peter. Again, my name is Ben Willis, and I will be moderating today's discussion. Today, we're going to be talking about, as Peter said, the legislative landscape in light of potential tax reform. This panel represents a special collaboration between IFA USA and Tax Notes, and I'd like to thank them both for this joint presentation. In particular, I'd like to make a special thanks to Peter Connors, Jasper Smith, Joshua Odens, and Peter Billingsley. I'd also like to thank Peter again for his thoughts on Pearl Harbor Day. Last week, President Biden proclaimed today National Pearl Harbor Remembrance Day. 80 years ago today was the day that brought my father into collaboration with those from around the globe. Now, let's walk through the objectives for today's discussion. By the end of this session, you'll be able to understand key changes to the international tax rules proposed in the November 19th House-passed Build Back Better Act, including the existing beat and guilty regimes, and some similarities and differences between the guilty and Pillar 2. Now, I'm going to go ahead and introduce our incredible panelists. Next slide, please. Thank you. Mindy Herzfeld is a professor of tax practice at the University of Florida, Frederick G. Levin College of Law, where she teaches courses in tax policy and international taxation. Mindy also serves as of counsel at Atomic Law Group. Since 2014, Mindy has been a contributing editor to Tax Notes International. Next slide. Loren Ponds is a member at Miller & Chevalier, where she counsels clients on a variety of international tax topics. Prior to joining Miller & Chevalier, Loren served as Majority Tax Counsel to the U.S. House of Representatives Committee on Ways and Means, where she worked on the international tax provisions of the Tax Cuts and Jobs Act. Doug Poms is a principal in the International Tax Group in the Washington National Tax Office of KPMG LLP. From 2017 to 2020, Doug served as International Tax Counsel in the U.S. Department of Treasury, where he worked from 2013 to 2020 and was a lead U.S. delegate to the OECD's Working Party 11. Next slide. So we're going to go ahead and kick off with some preliminary perspectives from our three panelists. Loren is going to start us off with some perspective from the Hill right now. Loren, please.
Thanks, Ben. So before we get into the mechanics of what we're going to talk about today, we thought it would be good to give everyone a bit of an overview about where we stand with this legislation. So, as Ben mentioned, the Build Back Better Act is currently pending before the Senate, having been passed out of the House shortly before Thanksgiving. As we all know, it is the Democrats' hope that this bill will be passed this calendar year. And indeed, just yesterday, we saw two Dear Colleague letters from Senate Majority Leader Schumer signaling his intention to do just that, even if it requires weekend work. Unfortunately, there are some things that may work against him. First, by all accounts, the senators have not agreed on the contours of key tax provisions not the least of which would be agreeing on what is the appropriate level of cap for the SALT deduction. In addition, there are some other must-pass pieces of legislation that will require the Senate's attention also before the end of the year. So the National Defense Authorization Act, NDAA, is due to be considered by the Senate this week. Debt ceiling legislation needs to be passed at some point. The exact date that we will reach the debt ceiling hasn't been communicated by Treasury yet, but it is sometime between now and the end of January. So also late last night in a second Dear Colleague letter, Leader Schumer signaled his intention to address nominations this week, as well as voting rights legislation before the end of the year. So there are a lot of things on the calendar, and today, as you know, is December 7th. In addition to other pending pieces of legislation that will require the Senate's attention, the key participants in this process, Senators Sinema and Manchin, have communicated no sense of urgency with regard to the timeline. And in fact, both have hinted that passage in 22, presumably earlier rather than later, would be acceptable to them. And so, you know, with each passing day, the likelihood of seeing this bill enacted this year gets lower. We'll have to wait and see. But as I mentioned, you know, we are late in the year, and there are many other competing priorities that the Senate must address before year end. Ben, back over to you.
Thanks so much, Loren. Appreciate that. We'll move on to the executive perspective, and Doug will share some thoughts on Treasury's and the IRS's perspective. Thanks, Doug.
Great, thanks, Ben. It's great to be here with you all. I remember well being at Treasury just before TCJA was enacted, and once it was enacted, there was an enormous burden on Treasury and IRS to put out a huge amount of guidance right away. And if this legislation is enacted, similarly, this Treasury and IRS will have a lot of work to do, no doubt. Some notable things about this particular legislation is that there are numerous and comprehensive grants in this legislation. I think that will be helpful in allowing Treasury and IRS to put out the guidance that needs to be put out, and a lot will need to be put out. Another notable thing is that certain provisions, some of the newer key provisions, like the corporate min tax that we'll talk about, 163N, some of the changes to the GILTI rates and such have delayed effective dates. Right now, I think they're proposed to take effect in 2023 instead of 2022. But there are a number of provisions that take effect upon enactment or for years beginning after enactment, including some significant changes to BEAT, Subpart F, GILTI, FDII. So no doubt Treasury and IRS are going to have a lot to do if this legislation passes, and I'm sure they're thinking hard about it. And once if it does pass, a key task that must occur right away is prioritization and identification of all the guidance that needs to be put out. And I know all of us will look forward to getting some public notification of what the guidance to expect will be if the legislation is enacted. So thank you, Ben.
Thank you so much, Doug. Appreciate that. Mindy, your thoughts on the global perspective?
To the extent that it is ever possible to talk just about U.S. international tax legislation or regulatory developments in isolation from the rest of the world, this year one really can't do that. As I'm sure everyone listening to this panel is well aware, in early October, the OECD announced that it had achieved a historic milestone of reaching agreement among I think 147, maybe I get my number wrong, countries that, maybe it's 144 countries that are agreed to implement major international tax changes. Those are known as Pillar 1 and Pillar 2. Both of those have implications for the U.S. tax legislative and potentially regulatory process as well. The more immediate one is Pillar 2 changes, which are the changes to is the plan for enactment of a global minimum tax. The U.S. obviously enacted its version of a global minimum tax in 2017, but it needs to, the administration has proposed changes to the 2017 version, known as GILTI, in order to bring it into conformity with the OECD agreement, and also to bring it more in line with some of the democratic priorities. So that's moving ahead kind of in parallel with the legislative timeline that Loren referred to earlier. There are additional questions raised about other aspects of the bill and other aspects of U.S. legislation, such as the BEAD, and how those conform with the OECD proposal that we can try and make sense of a little later. So that's the Pillar 2 plan, which again is moving along on closely parallel tracks with the OECD and international developments and the U.S. developments. The other aspect of the international agreement, the Pillar 1, which is a plan for reallocating some portion of a small group of companies, about 100 multinationals, residual profits to market jurisdictions, is less clear how that fits into the U.S. legislative timeline, and is also more controversial in the U.S. And so we'll talk a little bit more about how that might or might not fit into the legislative timeframe overall.
Mindy, thank you so much. That was great. Before we go ahead and dive into a more detailed discussion, let me just remind all the participants that we'll be taking questions at the end of the conference, at the end of the panel rather, and please keep your questions so that you can ask them, and we'll do our best to get to as many as possible in this very condensed session, as most of them throughout the conference will be. One of the highlights that we had to gloss over in this preliminary perspective is just the exact timing, as we're not sure whether or not it will be 2021 or 2022 that this legislation is enacted. And as Loren said, it's looking more the latter as time goes on every day. But to Doug's prior comments, that will potentially affect Treasury's implementation, although as we'll see, and I would keep in mind the effective dates as we go throughout this, most of them inside of the November 19th version of the Build Back Better Act have been pushed forward. And so there should be some flexibility there. And then that will impact the points that Mindy just made as far as collaborations with the countries across the globe. So let's go ahead and get into that deep discussion. Next slide, please. Great. Doug, if you could start us off, that'd be great.
Sure thing, Ben. The first proposal we're going to talk about is the corporate minimum tax, because it has huge international overtones. So we thought it was important that everyone be aware of it. It was proposed as a way to deal with kind of a setback that that the Democrats had, in that they couldn't raise the corporate rate because of objections, particular senator. So they came up with other revenue raisers. This is one of them. It raises a lot of money, $320 billion over 10 years, but it is targeted only to the very largest companies, and that's in terms of amount of financial statement earnings, or adjusted financial statement income is the term that's used. Roughly $1 billion is the threshold, and the special rules for foreign parent groups apply as well. But at the time that the proposal came out, there was a kind of concurrent one-pager that came from the Senate that indicated that there were about 200 companies that would have that amount of earnings, the $1 billion threshold, doesn't mean that they would be subject to the tax, because there's other requirements for it to apply. But that gives some sense of the universe. However, there have been articles and commentators have indicated that the number that would probably be hit by this corporate minimum tax is significantly lower than the 200. So keep that in mind. This is not a provision that would be of widespread application, but it is a tax that also requires companies or a group of companies to have a significant book tax differences. So in addition to the high income threshold, it only would apply if there are book tax differences like accelerated depreciation, stock-based compensation, certain timing of accrued liabilities. Those are some of the factors you would look for as a company to see if you have to worry about this tax. But if you think you're going to meet the threshold or you model it, you would calculate your tentative minimum tax and compare it to your regular tax, and the min tax would be the difference. So I mentioned that you need to meet certain threshold requirements. That is, you have to meet the definition of an applicable corporation, which is $1 billion of adjusted financial statement income based on a 3-year average leading to the year before you're applying the rule. For foreign parented groups, if you're an international financial reporting group, there's an additional test. In addition, first, you would apply the $1 billion test to your global income, including your non-ECI foreign income. So it would be all the income of the foreign group for the $1 billion test, but there's a second $100 million 3-year average test that you have to have U.S. related income, which would be ECI, U.S. sub income, and CFC income that would total $100 million. So there's a second prong to the test. And another thing to note is this proposal would apply, as noted earlier, for years beginning after 2022 as proposed, so it won't take immediate effect. If we go to the next slide, the important point in this slide is once you meet the test to be an applicable corporation, you stay in that status, kind of like if you remember for PFICs, once a PFIC, always a PFIC. There's a similar concept here for applicable corps. However, Treasury is given authority to write rules that if there's a change of ownership or if there's a significant period where you don't meet the $1 billion threshold test over a period of time, Treasury has authority to write rules to take you out of applicable corporation status. If we move to the next slide, the critical piece to figuring out if you're in this test is looking at your adjusted financial statement income and your applicable financial statements. And there are a number of rules on how to do this calculation, and the details are really important. For instance, you apply it at a taxpayer by taxpayer basis, but you're looking to meet the threshold, the $1 billion threshold, by looking at a group financial statement if you file as part of a group, and you aggregate all entities that are a part of the same employer group under Section 52, which is a similar concept that's used under the BEAT for the gross receipts test there. So there are a number of aggregation rules that you have to consider. The special rules apply if you're a U.S. consolidated group. Then there's special rules that apply for entities that are not in your consolidated group. And again, attention should be paid to those rules. If you, for instance, use equity accounting, you wouldn't pick up, for minority entities, you wouldn't pick up your share of earnings of those. You would rather pick up only the dividends that are received from those entities, or certain inclusions, like QUEF inclusions related to those entities. But if you use, for instance, fair value accounting for your investments, there's a question if you're applying mark to market to those investments, whether those marks, that the income from those marks or the gain from those marks are included in adjusted financial statement income. And that's something that needs to be addressed, I think, in future guidance. For CFCs, you pick up the taxpayer would pick up its share, pro rata share of the net income of the CFCs, even if their income or losses. But if it's an aggregate loss, you wouldn't take that loss, but you would carry it forward. And then for disregarded entities, you would pick up your share if you're not already picking them under financial statement principles. And finally, for foreign corporations, we're told to use under the proposal to use principles similar to 882, but there's a lot of questions on how that actually would work for financial statement income, and that's something Treasury would need to put out guidance on. If we move to the next slide, that just talks about the availability of an AMT foreign tax credit, and that calculation is twofold. For the income coming up from CFCs, there's an actual limitation on that, which is 15% of the net income coming up from the CFCs, and any excess could be carried over for 5 years. But then the foreign taxes that are directly paid by the taxpayer through a DRE, there is no limit on those taxes, and query why there's a difference in the treatment, but there is. So pay no attention to that when modeling. If we go to the next slide, there's rules that allow NOLs to be considered for this calculation. You get to carry forward NOLs that are financial statement NOLs for post 2019, but there is a limit similar to what's under regular tax, that you're limited to 80% of adjusted financial statement income. But NOLs can be carried forward indefinitely. Then there's general business credits that are also available against the minimum tax with certain limitations that you need to pay attention to as well. And if you are subject to the min tax, you get a credit for years where your regular tax exceeds your min tax. So that's kind of an overview. I know that's a lot because there's a lot of detail, but we want to spend time on other things. But I don't know if anyone else in the group has any thoughts on this.
Yeah, Doug, I just think want to add a little kind of historical color to this. This isn't the first time the U.S. has proposed an alternative minimum tax based on corporate book income. And so we did that back in the 80s. And the important point there, I think, is that it only lasted a couple of years because Congress realized that taxpayers could manipulate their financial statement earnings perhaps even more easily than their taxable income as defined under the code. And so they realized it wasn't the best. So there were two downsides. One, it wasn't producing the revenue they expected. And two, it was potentially causing a distortion in financial statement reported earnings. And so I think one has to question, taking into account where you started with the reason why this was proposed, and rather than just a simple, much more simple couple of point increase in the corporate rate, how long this really would last. The flip side to saying that, well, maybe this won't last so long, and so perhaps I don't have to pay attention to it, is I think that some of the themes in here are consistent with some of the other changes being proposed. You're about to talk about 163 yen, so I won't take that. But the OECD model rules for Pillar 2, obviously very dependent on financial statement income, and so even if this particular corporate minimum book tax doesn't last all that long, it would seem that some of the principles that it's relying on may be part of a larger, longer-term trend.
Yeah, those are excellent points, and it is interesting how many of the new proposals, both in the U.S. and the OECD, are looking at financial statement income, and query whether Congress would have any concerns about ceding kind of the base for tax rules to financial accounting standard setting boards. It takes some of it out of their hands, and you wonder if that might be a concern if that happens too much in our tax laws.
Yeah, I guess that related to that is a whole controversy that this is kind of spawning about whether Congress should be inserting itself into kind of FASB's territory and writing and influencing the accounting rules, and so that's kind of a sidebar to this provision.
Doug, I would also make the observation, you mentioned a lot of broad grants of regulatory authority throughout the provision, and I just think that it's important to take into account the timeline for passing the bill. So this delayed effective date was somewhat meant to give Treasury time to write these rules, and the longer it takes for this bill to be passed, of course, the less time Treasury will have to write the rules. So I think it is important to kind of identify, you mentioned a lot of these rules are complicated and very specific, but the importance of trying to figure out how they might apply is important, because the next step is going to be seeking regulatory guidance.
Yeah, absolutely, Loren. And I know I can see how much Treasury will have on their plate dealing with with this provision alone, but there's so many others happening at the same time, and it's an enormous undertaking. But in this particular, whenever it's a new regime, and this regime is, even though there have been, as Mindy said, there have been corporate minimum tax in the past, but this one is designed slightly differently. So there's novel issues that come up, and there are a lot of questions that would need to be answered, as there always is with the new regime, and guidance will be paramount. And so we'll see what happens if this is enacted. And but for now, we have a polling question coming up. So let's go ahead and do that.
That's a hard polling question.
Yeah, it's a more thoughtful one.
I'm going to go ahead. I'm going to share a couple thoughts while we wait for the results, just on Loren and Mindy's last points. One being on the Treasury grants of authority. I think that you could talk about that for a long time. There's a lot of potential interesting things there. One just being an understanding of the difficulty of reconciliation legislation, the speed at which it moves, and the need for additional authority in order to complete it, so to speak, to say it roughly. And at the same time, perhaps just collaboration, an acknowledgement of additional collaboration between the branches of government. And then on Mindy's point, real quickly, I don't think anybody can argue that the financial income impact will add much complexity in this area. And so I can certainly appreciate the choice in the 80s to push back, and a lot of comments that folks are giving now about the complexity there. At the same time, I just want to acknowledge that it's not displacing the current income tax rules. And so the systems would run parallel. So while there certainly would be complexity involved there, it'd be the lesser of under the book minimum tax or the general tax principles that apply. So it's more of for that anti-abuse measure to kind of ensure that they're both running parallel. So it looks like we have 83% for foreign groups with ECI, and that is the correct answer.
Yeah, very good, everyone. And that's important to remember that this proposal applies to both U.S. groups and foreign groups that are part of an international financial reporting group, or not, but that have foreign entities with ECI would be cut by this rule if they meet the thresholds. Now we can move on to the next proposal, 163N, which is another provision that is based on financial statement income. It's a new limitation on top of 163J that would limit interest expense in the U.S. And this one is focused on the relative amount of leverage in the U.S. from a financial statement perspective. The calculation would require considering whether a group of companies And this could be a U.S. parented group or a foreign parent. It applies to both, unlike the Treasury Greenberg proposal would only have effectively applied to foreign parented. This proposal applies to both foreign parented and U.S. parented groups, but you do have to have a group. And you're looking at the financial statement, U.S. interest expense, and saying if the group is over leveraged in the U.S. by looking at what percentage of the worldwide interest expense should be U.S. interest expense based on relative amounts of EBITDA in the U.S. versus worldwide. And if there's an excessive amount of U.S. interest for financial statement purposes, you would adjust your tax U.S. interest expense by that same percentage, but you do get you get to 110% of that amount, so you do get a slight uptick from the financial statement ratios. But it is a book-based determination, another one like this. There's certain exceptions for Escorts, REITs, and small entities. And it's important to note that this 163N proposal applies on top of 163J's. So if you get a worse answer under 163N, you would take that limitation, which would be a less amount of interest expense and more disallowed interest expense. If you got a better answer than 163J, then 163J would apply. That is interestingly different from other countries that have adopted this type of group ratio or kind of a worldwide EBITDA ratio. In other countries, they apply this test as a safe harbor. It can only help you. But in the U.S., this version, this proposal, it can only hurt you. It can only give you a worse answer. If we move to if we move to the next slide, that really talks about this computation. Sure, Mindy.
Do we know how many countries have implemented this kind of 163N rules since the OECD's report, BEPS report?
It's a significant number because of it was a recommendation coming at Action 4, but not by no means to have all countries, but a number of our major trading partners have adopted a variation of this rule. Some of the other countries have adopted rules that are based on debt equity ratios or debt to asset ratios as opposed to EBITDA, but it's a similar concept of looking at the local country leverage versus worldwide leverage, and a significant number have adopted some form of it, but again, as a safe harbor and not as a second restriction. So this is an area as well where Treasury is given a lot of authority to implement this rule, and that's going to be very important. Treasury has authority to decide which groups are part of the International Financial Reporting Group, and making this determination, which would be critical to how it plays out. Treasury has authority to give an election for taxpayers or to allow certain types of entities to be included if it's a lower threshold than being part of the consolidated group for financial statement purposes. And one area of note for the regular authority is there is one of the kind of questionable policy aspects to the way this rule works is CFC would be a foreign corporation. Its earnings would count as foreign EBITDA, not U.S. EBITDA, but the earnings of the CFC could be subpart F income and subject to U.S. tax. So it seems rather harsh to apply this kind of rule when the earnings are actually being subject to U.S. tax and not counting them as U.S. earnings. Treasury does have authority to treat interest income that is subpart F income and interest expense of CFCs as interest income and interest expense of a domestic corporation. In an earlier version of the bill, that was all subpart F income, not just interest income, but that was subpart F income. But in the latest version, it was narrowed to just being interest income. But that seemed to be a move in the right direction of recognizing problems with treating subpart F earnings as foreign earnings and applying interest restrictions on top of other limitation rules that apply for foreign tax credit purposes. I think Loren will talk a little bit about that. But that's just another example of the reg authority here. The last point about 163 and its combination with 163J is whatever is disallowed, you're able to carry that forward indefinitely. And in the latest version of the bill, it was changed from a 5-year carry forward to indefinite, and that is a positive change that I think was welcome. One thing to think about in the interplay 163N and 163J is 163J is scheduled to move from an EBITDA 30% ATI based on EBITDA standard and to an EBIT standard. And if that happens, then 163J would be have much more impact on taxpayers than 163 and would have less of an impact. But right now, right now it's scheduled to move from EBITDA to EBIT, but query whether that actually will happen, if there could be an extender or something that would change that. So stay tuned for that. So with that, I'll finish with 163J, unless there's any other thoughts on that.
Doug, that was great. Thank you so much.
I have a question, Doug, about all the regulatory authority. I know you were at Treasury really the whole time. I think that you had to deal with putting out regulatory and other guidance and interpreting a TCJA. There seems to be an assumption in the bill that people writing the regs will have the same overall goals and priorities as the drafters of the statute. And so how realistic, given all the broad grants of regulatory authority, how realistic do you think that assumption is? That the reg writers would get everything done before a potential turnover and
depending on the scope of the bill, if it's a current proposal, there's a lot of, as you said, there's a lot of areas that require reg grants. There are a lot of areas that guidance is needed. Some of the provisions aren't taking effect right away, so that gives a little time, as Loren pointed out. But I think it's a question of setting priorities. Treasury and IRS could decide whether to try to issue regulations and in both proposed and final form within this administration or not. I mean, there's no requirement. I think by necessity, some of the guidance is going to be necessary for the rules to really operate as intended, and there'll be pressure from both taxpayers and within the government to get those particular reg projects done. Other pieces potentially could wait a bit longer if they're not critical to the operation of the rules. But one thing that's certain is that there will have to be prioritization in terms of which regs to try to get out first, and which issues to address, and that pressure or that those decisions will be made both internally and with consultation with the Hill and conferring with taxpayers about what's most important to get out soonest. But the Treasury and IRS will make their own interpretations of the statutes when they're interpreting it. So Congress has their chance to do it now, and if they don't make it clear what it is, if something's important to them, they should make it clear either in the text of the legislation or shaping the reg grant in a certain direction if they want Treasury to go in a certain direction.
I really like this question that Mindy posed. I just think it highlights the tension created by reconciliation legislation. One, because of the complexity and the amount of guidance that's needed. And then two, of course, the fact that if there's a change in administration, and it could very well affect the likelihood that the regulations align with the intent of Congress, and there's some uncertainty there, right? Of course, we like to think of a pure harmony, but without legislative history, which certainly seems to be the case this go around, it raises some interesting questions. Thanks so much, Mindy and Doug, for that response. To move on to our next section, I know we've got a lot to cover, so I'm going to go ahead and tee up Loren, who is going to walk us through a number of rules. If you could switch to the next slide. One more. Perfect. Thank you so much, Loren.
Thanks, Ben. So I'm going to spend a few minutes going over modifications that are pending in the Build Back Better Act for BEAT and GILTI. I'm going to start with BEAT. So Mindy mentioned in her introductory statements, and she will expand on this in the discussion of Pillar 2, but I think it is important to keep in mind that some of these changes to BEAT and GILTI are kind of the result of bidirectional forces. So the impact of OECD's Pillar 2 work on domestic policy, but also the administration's desire to advance some of the modifications that it would have liked to have seen with regard to BEAT and GILTI on the international stage. So with the rules as they ended up being finalized in the Pillar 2 context. So right now, the BEAT has been modified in much the same fashion as the slide says. So harsher rules, but applicable to fewer taxpayers than the current rule. As Doug mentioned, with the corporate AMT, the need to raise revenue was brought to bear once corporate tax increases were off the table, and we see that also in the BEAT context. So the rates are higher than originally proposed in the Ways and Means version of the bill, culminating in 18% beginning in 2025. You will also note that at the same time, the higher rates for BEAT for banks and financial institutions have been repealed or proposed to be repealed in the new version. A new version a new feature of the provision, similar to the adjusted financial statement income concept in the corporate AMT space, is that once a taxpayer is subject to the BEAT, they will remain subject to the BEAT for 10 succeeding years. So it's kind of a similar concept to once you trip the wire in terms of a threshold amount for adjusted financial statement income, you're kind of in that world for a subsequent number of years, regardless of what your actual calculations are. Another positive change is that all credits are added back to regular tax liability, which is a positive development, particularly when one considers that after the BEAT was enacted in 2017, a large number of complaints were levied against the provision based on the fact that foreign tax credits were clawed back. And so many U.S. multinationals felt that by operation of the treatment of foreign tax credits, they were pulled into BEAT liability when, based on the statements in the Senate Budget Committee report, this provision was really meant to only apply to inbound taxpayers. And so now all credits, general business credits and foreign tax credits, are added back to regular tax liability, which operates to reduce the delta between your regular tax liability and your modified taxable or tentative BEAT liability when you're calculating whether or not you will be subject to the BEAT. But a part of that is also that there is no BEAT foreign tax credit. So that's different than what is currently proposed for the corporate AMT, and some taxpayers asked for that as well when modifications to BEAT were being considered in 2017. The availability of a special foreign tax credit only to be applied against BEAT liability, and that remains not a feature of the provision. So the modified rules have two types of income that are excluded, specifically excluded from the definition of a base erosion payment. One, and a new addition to the provision, is that payments that are subject to a sufficient rate of foreign tax are excluded, and that rate is the lesser of the prevailing beat rate, or 15%, which has obvious linkage to the minimum tax rate in the Pillar 2 context. Secondly, payments that are subject to U.S. tax without regard to deductions taken under sections 241 through 250 are also not treated as base erosion payments. Another modification is that after 2023, the 3% threshold for tripping the beat wire, so to speak, will be removed. And so currently, a lot of the calculus for beat liability rests with staying below the 3% threshold. So making sure that your percentage of base erosion tax benefits is no more than or just under 3% of your total deductions taken. This threshold will be removed. And so instead of this 3% rule after 2023, the focus will shift entirely to looking at the effective tax rate to determine whether or not taxpayers will have beat liability. Next slide, please. Another major modification is to the existing COGS exception to the beat. Now, the new rule targets amounts paid with respect to inventory such that they are excluded from COGS for purposes of determining modified taxable income. So your modified taxable income will be higher because these types of costs, as enumerated on the slide, will not be considered COGS and therefore will be treated as base erosion payments. First are indirect costs. Those are defined based on the 263 Cap A regulations, and they most often one might think about royalties for licensing IP associated with tangible goods that are held in inventory for resale. And then the second category are amounts paid to acquire property that's inventory in the hands of the taxpayer. So the amounts paid are treated as base erosion payments to the extent they exceed the direct costs of the foreign related person to produce the property or acquire the property, and indirect costs. And there is a safe harbor for indirect costs so that the need for looking through and determining the actual indirect cost is obviated, such that 20% of the amounts paid by the taxpayer to the foreign related person are treated as indirect costs and subtracted. And so the amount paid minus the direct costs minus the indirect costs, and if it's the safe harbor, the indirect costs are equal to 20% of what's paid, and whatever is left is treated as a base erosion payment. And the next slide illustrates this with an example because it's a little bit easier to see with numbers. So if we have US Co paying $100 or 100 to a foreign related person, FCO, for the acquisition of inventory, and FCO's direct costs are $75. US Co also pays a royalty of $15 to FCO for the rights to sell inventory property, and it capitalizes that royalty paid into inventory under 263 Cap A. So the analysis shows that the 15 royalty likely is an indirect cost described in 263 Cap A, et cetera, and is treated as a base erosion payment, full stop. Then we apply the excess rule to look at the 100 paid and to determine how much of it is treated as a base erosion payment. And remember that the rule is the excess of direct costs plus indirect costs. So the direct costs we know from the slide are 75. And the indirect costs, if we apply the safe harbor, would be 20. So 20% of 100. So 75 plus 20 is 95, and that would leave a remaining 5 to be treated as a base erosion payment. And once you do this math, you still have to consider the effective tax rate of the foreign recipient, because if it is higher than the lesser of the prevailing beat rate or 15%, then even though the amount paid exceeds direct plus indirect costs, you're still excused based on the rule that the effective tax rate is high enough, and so the amount paid is not treated as a base erosion payment.
So Lauren, the distinction is there's this look-through rule applies to inventory property only. So if you're making a payment for inventory, but other costs that are capitalized into this capitalized under 263 Cap A, those are just fully base erosion payments. If they're like the royalty in your example.
Yes. So anything that's treated as inventory and capitalized, for which the indirect cost plus direct cost rule doesn't apply, then you go back to that first rule, and those are treated as base erosion payments as well. But it's important to realize that the COGS exception still exists to a certain extent. It's just that these amounts will be carved out of it.
And the effective rate determination also applies to all payments, not just to the COGS.
Right, it applies to all payments. So the ETR, those are prevailing rules. So if it's subject to U.S. tax, or if it's subject to a sufficient rate of foreign tax, those payments are carved out of the definition of base erosion payments altogether. Next slide, please. All right, we have our next multiple choice question. And this is to see if you were paying attention to my BEAT presentation.
I can't help but get curious about these. Some of them were tricky. Some of these were tricky. So I'd like to watch the numbers adjust, or at least take a minute to read, which is good. So it looks like the third answer is by far in the lead, and that's the safe harbor test for the portion of indirect costs that will reduce amounts paid to a related party for purposes of determining the base erosion payment. Great. Okay, next slide.
All right, so we're going to go pretty quickly into oh wait, did I skip a BEAT slide? Maybe. All right, we'll come back to that if we have time. So guilty. Again, these modifications are somewhat consistent with what's happening in the Pillar 2 space, which Mindy will go through in more detail. The cons of the proposed modifications are certainly the higher rate. So now guilty is consistent with the global min tax rate of 15%. And of course, the country by country calculation of the inclusion is another major change. And also the net deemed tangible income return is reduced from 10% to 5%. So the percentage of QBI that is treated as a routine return and thus excluded from the guilty calculation has been diminished from 10% to 5%. The country by country analysis, of course, means that the inclusion is determined separately with respect to each country in which any CFC taxable unit of the U.S. shareholder is a tax resident. But that calculation also has knock-on effects such that the analysis of on a country by country basis also flows to other items of income and other amounts that are calculated for purposes of guilty. So that includes net tested CFC income, the net deemed tangible income return, QBI that's allocable to a certain jurisdiction, and interest expense. And of course, foreign tax credits. And so this new concept of CFC taxable unit is defined in a new section of 904 E2 Cap B. But as many of you will note, the concept of a taxable unit has shown up, particularly in regulations that have been promulgated since the enactment of TCJA with regard to foreign tax credits in particular. So the pros of the proposed modifications, one is less of a foreign tax credit haircut. So instead of 80% of the taxes attributable to the guilty basket, taxpayers are now able to claim 95% of those credits. Another significant change is that the expense allocation rules to the guilty basket have been significantly softened, such that only the Section 250 deduction is allocated to the guilty basket, plus there is regulatory authority to allocate any directly allocable expenses to the guilty basket. But the effect of this is really to render the guilty rate much closer to the headline statutory rate. As many are aware, under current guilty rules, the way that expense allocation works varies widely from taxpayer to taxpayer, and so the degree to which one might be required to allocate interest, stewardship, R&E expense to the guilty basket will affect the availability of foreign tax credits, which of course will drive up the rate if those credits are limited. Next, the Section 250A2 taxable income limitation is eliminated, so that applies for both FDII and guilty, such that by the time you currently are looking at those deductions, if they exceed the amount of taxable income you have, the FDII and guilty deductions would be limited. That limitation is removed in the bill currently pending before the Senate. And that some of you may be aware that the limitation operates such that you may need to apply simultaneous equations if you're trying to figure out your limitations for several limited deductions like 163J, NOLs, and FDII. So to figure out how they interact and which one you take first, there's some very complicated math involved. So now that is proposed to be eliminated, you will get a better result. It's a taxpayer favorable result. And lastly, for sandwich structures, there's a foreign tax credit mechanism for income inclusion rule taxes paid to the ultimate parent entity, which we probably will discuss a little bit more later on.
And also, Laura, there's the 5-year carry forward for the guilty credits. That's an that's an important one.
Yes, so that's another big deal. Thank you, Doug. So instead of being limited, your 960 credits being limited on a year-by-year basis, there is now a carry forward permitted. Although I think, did they shorten it? It was 10 years.
No, it was.
Oh no, it's 10 years later. Yeah.
It's 5-year carry forward for the 10-year period. I think that the budget window that it changes. I think that.
Yeah. Next slide, please. And here we have some miscellaneous changes to other international provisions. So FDII, the deduction for FDII has also been modified such that it matches the guilty rate, so 15.8% for both. You know, many will view this, even though the deduction is less, the fact that FDII is retained is a positive, since the administration proposed in the Green Book to repeal it in the Senate Finance Committee in its international tax discussion draft or white paper also signaled that it was not sure that the provision should be retained. So that it has remained is a plus. And that the rates are now linked again is important for the WTO discussion. So kind of a counter argument against the charge that FDII might be viewed as an export subsidy. I already mentioned the elimination of the limitation, 258.2 limitation. And another change is that the Section 250 deduction is allowed to be taken into account for purposes of determining your NOL under Section 172. FDII has also been expanded to include additional types of income that are not included in your deduction eligible income. So first, there is a rule for property giving rise to rents and royalties derived in the active conduct of a trade or business. There is room for regulations to be issued that can modify or soften the effects of these rules, but the income from the gains from the sale or disposition of these types of property are excluded from deduction eligible income, and also passive income is excluded from DEI. And this rule did change. It did have a reference to foreign personal holding company originally, and that rule has been modified to refer to Section 904D2, Cat B, Romanettes 1 and 2. And so that is helpful because there are some 904 regulations which provide further clarity on what constitutes passive income, particularly with regard to types of income that might be excluded from passive income. For example, by virtue of CFC look-through rule, which could help boost up the DEI number for taxpayers seeking to take advantage of the FDII deduction. Another major change is the 100% DRD for the foreign source portion of dividends under 245 Cap A is modified such that only CFCs, dividends paid up from CFCs as opposed to CFCs and 1050 companies, as is current law, will be eligible for the dividends. But there is a provision that allows taxpayers to elect to have foreign corporations treated as CFCs. The foreign tax credit rules, as I mentioned, move to a country-by-country system, and also the branch basket is eliminated, which would mean that those taxes would revert to the general basket once that foreign branch basket is no longer. And finally, the R&D amortization provision is delayed until tax years beginning after 12/31/2025. And so that provision would require 5-year for domestically incurred R&D expense and 15-year for foreign incurred R&D expense to be amortized. So that's a win for those who are R&D heavy. So I'll stop there and make sure we have enough time for Mindy.
We have another polling question?
Yes, we do.
Okay.
If the proposed modifications are enacted, which of the following are true? We'll go ahead and give this a minute. We've got roughly 20 minutes left, so we're going to try to move through these final but very important discussions on the OECD and some Q&A from the audience in that time. I see the majority of the folks here have selected the correct answer, which is the foreign tax credit rules move to a country-by-country system. Great. Next slide.
All right, so I was listening to both Loren and Doug kind of with this OECD model rules hat on and trying to puzzle through how it all fits together. And I have more questions than answers, so I'll just throw out some questions in the next few minutes, and hopefully one day sooner rather than later, we'll have some answers as to how this fits together. Okay, so just to recap, overview here, the high-level agreement about a minimum tax, global minimum tax, and this Pillar 1 proposal was reached in October. Pillar 1, again, is reallocation of residual profits of very large multinational, profitable multinationals. Pillar 2 is a global minimum tax. Only as proposed to apply to multinational companies with more than 750 million euro in revenues. obviously, the U.S. Guilty does not so limit its application. That's only one of the many differences between the global minimum tax. I have minimum tax plus because the global minimum, the GLOBE, as it's called in the OECD Pillar 2, and it has 3 components. What is known as the income inclusion rule, which is kind of the counterpart to the U.S. Guilty, what's known as the undertax payment rule, or the UTPR, which is a kind of counterpart to the U.S. BEAT, and then something called the subject to tax rule. All right, so high-level agreement reached. OECD says working hard on implementation. Sure, I'm sure they are. Unfortunately, for them and for us also, I guess, turns out it's easier to reach high-level agreement than to actually figure out what that agreement means. And so the model rules and commentary, which were supposed to be released in November, are now delayed and delayed again. So I think we're still hoping, unlike the Build Back Better Act passage, I think we're still hoping for the OECD materials to be released before year end, but we'll see. But the implementation raises many questions on the U.S. Legislative side. What is necessary for Pillar 1, some kind of multilateral instrument? Will U.S. Congress ever ratify such a thing? Many, many questions which we do not have time to go into here. And then on Pillar 2, the questions raised have to do with kind of what does implementation mean for the U.S. in terms of how the OECD proposed model rules interact with the existing law and the proposed changes in the Build Back Better Act. Next slide, please. Okay, so going through Pillar 2, 3 components, as I said, there's minimum tax, what's known as the income inclusion rule, the undertax payment rule, and the subject to tax rule. I'll just mention the subject to tax rule briefly. It gets very little attention in the United States. It's a treaty-based rule for developing countries, specifically developing countries hoped that they would get a lot out of this OECD agreement, but as you can all tell, because you barely hear of the subject to tax rule, that does not appear to be as successful working out for them as well as they hoped. Okay, so minimum tax, how close is it to guilty? There are both significant similarities and significant differences. Guilty still retains, unlike the corporate minimum tax, book tax that Doug was describing, guilty still retains as the basic concept that U.S. taxable income concepts are the building blocks of the tax, whereas the OECD proposal relies on financial statement income. And so one question is, will these differences matter? I know, Doug, that you have assured me that the U.S. will not sign on to anything that does not specifically bless guilty, but I don't know what that means exactly. Guilty in perpetuity, no matter what changes are made to it. Does it mean they have to write out a specific rule for saying here's the guilty that will be carved out? So that's one set of questions, and then another set of questions is to what extent are the existing rules, to what extent do the differences matter? Even bigger question, even bigger differences between this undertax payment rule and the BEAT, and so the question there is to what extent do these differences matter at all? And then really no direct parallel in any U.S. legislation to the subject to tax rule. Next slide, please. So one question is rate. The OECD agreement originally was at least a 15% rate, and now it's supposedly because of pressure from Ireland, it just says 15%. What are the implications of that rate? So there's the global minimum tax, the effectiveness of it apparently hinges on whether it's imposed on a country-by-country basis. And so, notwithstanding that the U.S. enacted a form of a minimum tax in 2017, many other countries view the U.S. Minimum tax as providing the U.S. with a competitive advantage unless that minimum tax was imposed on a country-by-country basis. And so the administration has proposed that they may have, regardless of OECD developments, modifying GILTI, as Loren walked through, on a country-by-country basis. But I think one question, given the kind of quagmire that Build Back Better is in, is what happens if this legislation does not pass? What would that mean if the U.S. Doesn't modify its GILTI rules to be on a country-by-country basis? And I guess my question is really, why is that so important? Country-by-country will save the world, but the rest of the world thinks so. So that's one area where the U.S. is moving closer to the OECD, but time will tell. Carve out. The OECD rules would propose carve out one based on return on tangible assets, similar to the GILTI QBI exception, but in addition to that, would also have a carve out for a percentage of payroll, which the U.S. obviously does not have. And so the OECD model is obviously a narrower inclusion, or a narrower minimum tax, and that the carve outs are much more generous, and notwithstanding that they say that the carve-outs are 5% of return on tangible assets and 5% of payroll. They're actually 10% and 8%, and then only go down to 5% over 10 years. And so really much more generous than what the U.S. currently has and what the Build Back Better Act would propose. And so again, inconsistency in which the OECD rules. The U.S. has a much more expansive minimum tax than the OECD is agreed to at the OECD. And then there's question of carryovers. Loren went over some of the changes that are being proposed to carryovers in GILTI, and there's loss carryovers in the calculation of a minimum tax and the calculation of the effective rate. There's tax credit and tax carryovers. So we've got one set of rules for the U.S. GILTI. We've got another set of rules that Doug walked through for the corporate minimum book tax for loss carryovers and foreign tax credit carryovers. And then we've got a whole nother set of carryover calculations under the OECD proposed rules. And so I have a headache just saying that. And so trying to figure out how three separate, at a minimum, three separate calculations of loss carryover accounts have to be kept on an annual basis for a company is really mind-boggling. Next slide. Okay, so again, the effective tax rate calculation. So Loren mentioned an effective tax rate calculation for BEAT. Obviously, for GILTI also, there's the determination of the amount of foreign tax paid per entity or per jurisdiction is relevant for the GILTI calculation of the foreign tax credit availability. The OECD proposed rules have different set of ETR calculations. Again, presumably the U.S. system, which rests on notions of what a foreign tax paid is and how that's creditable under U.S. tax principles, is different from the OECD calculation, which just looks at financial statement. Loren, you did not get to mentioning the status of the proposed foreign tax credit regulations, which I guess are now imminently due for release. But those would seem to strike a larger wedge in between what is a foreign tax or a tax for OECD purposes and creditable under US rules. So again, highlighting large differences between these two systems and question how taxpayers will be able to reconcile these differences and all the different kinds of calculations that will need to be performed, especially acute for larger taxpayers.
Yeah, so Mindy, that's a good point. The foreign tax credit regs that are at OIRA now, in their proposed form, referenced novel extraterritorial taxes and said that they would not be creditable based on foreign tax credit rules that are currently in existence. And ostensibly that was meant to reference digital taxes, so these unilateral measures. But it does raise the question of how these taxes that are paid either in a Pillar 1 context particularly. So if once Pillar 1 agreement is reached, how would those taxes be treated? One would imagine that they would be creditable. One would hope that they would be creditable, but it's unclear what novel extraterritorial taxes would encompass, because I think it is meant to be broader than just digital taxes as we currently understand them. But I'd be interested to hear you and Doug's thoughts on that, if you have any.
Well, I think the next slide goes through the UTPR, and I am stumped. You said whether Pillar 1 taxes are creditable. I'm completely confused by the UTPR calculation, which seems to require some kind of allocation of taxes among jurisdictions, similar but not the same as Pillar 1 allocation of income. And so I don't know how the U.S. system, maybe it doesn't matter because maybe that's only on an inbound basis, but I don't know how the U.S. system would figure out whether reallocated tax payment under this UTPR rule is a creditable tax.
Mm-hmm.
I mean, wouldn't that be an essential part to making Pillar 1 work properly? Definitely thought is being given to that, and maybe we'll see that addressed in this upcoming package. But Mindy, I thought your question about guilty coexistence was really good. I mean, does the U.S. really need to get these changes to guilty made in order for guilty to be acceptable regime for Pillar 2 purposes? I think the administration feels very strongly they need to get these changes made, and they're pushing hard in this legislation for them, particularly getting the rate up to 15%, because that has obviously is something that was agreed to as a fundamental part of Pillar 2, and then country by country seems to be an important part as well. So. My personal guess is the U.S., the administration will want there to be, hopefully they'll want this bill to pass, of course, and push for, the proposals in this bill to pass, and that would, go a long way toward guilty coexistence. But if there's another version of the bill coming out of the Senate or otherwise, I think the administration is going to insist that these changes be part of it, because this is such an important initiative to this particular administration, in particular. President Biden has expressed it, Secretary Yellen has expressed that, and so and it is, well, I don't know what the feeling is out there on a bipartisan basis, but I'm not sure it's one of the more controversial things within the Democrats.
Yeah, okay. Like I said, I have no answers.
Yeah. That's totally fair.
I'd be focused on this last bullet on this page, which is really I pose it here about the BEAD and that UPTR, which is why and where does it matter that they differ? And if anyone in the audience has an answer to that question, please put it in the chat or otherwise let me know. I don't know if that's the last slide or if there's another slide coming up. Is this the last slide? Okay, so effective dates. Loren and Doug, I think, both talked about the importance of effective dates on the U.S. side. The OECD rules have their own set of effective dates, and then there's Pillar 1 effective dates, and to what extent does coordination of effective dates matter is another question. And then, you know, given how the U.S. has really moved in front of the rest of the world here, both in 2017 and if the Build Back Better Act passes now as well, how or does it want to address the fact that it's moved ahead on some of these major commitments, and what action might it want to take if other countries don't? And then a whole series of questions about Pillar 1 that I think we have no time for, so maybe another panel on this event addresses it. Otherwise, I'm sure we'll be talking about it next year.
Great. Thank you so much, Mindy. Appreciate that. I know we have just a couple minutes left. I'm going to just say some final words. Thank you all for listening in. Last comments are just about tension. I think that's an underlying theme of a lot what's going on across the globe, across branches of government, within single branches of government. And tension can be a good thing. Tension can focus on making sure that folks who are represented and their best interests get heard. But there's tension between the governments that we're thinking about in these discussions. There's tensions within the government and deciding what is best for the people. And a lot of this tension can lead to progress. In fact, some of the largest tensions in the world have led to some of the greatest collaborations. And I think a lot of what we focused on in the current legislation, which is a number of minimum taxes, along with what's going on in the OECD and the minimum taxes that they're proposing, do align. And I think that's what the current administration is focused on, and Congress. Trade wars, tax that's becoming a big part of that is trying to be minimized. And folks in the IRS and Treasury are trying to bring solutions to those on the Hill so they can accomplish the goals for the people within the Build Back Better Act. What's good for California doesn't necessarily have to be bad for West Virginia. And that's true for countries around the world and America. And so as we think about collaboration, and where we started with this discussion today, I'd like us all to just appreciate the progress that the world has made. Thank you all for listening to these fantastic panelists. I appreciate it, and look forward to talking with you all again. Thanks.
Thanks, everyone.
Thank you, Ben.
Thanks, Ben.